Imagine pouring millions into a company with no product, no revenue, and no plan. Just a vague promise to revolutionize the internet. Now, imagine that same company getting a $500 million valuation overnight. Welcome to the late 90s, aka the Wild West of the internet, where adding .com to your company name could 10x your stock price, where Silicon Valley turned into Vegas, where venture capitalists lost their minds and average investors got absolutely wrecked. But what actually caused the .com bubble? How did it inflate so fast, and what made it all come crashing down harder than your friend's crypto portfolio? Today, we're breaking down one of the biggest financial manias in history, the .com bubble. We'll look at how it started, who made the money, who lost everything, and how it triggered a full-on economic recession. Let's get into it. Let's rewind to the mid-1990s. The internet is just becoming mainstream. Dial-up modems, AOL CDs, websites that look like your grandma designed them. But people could see the potential. Suddenly, everyone's talking about how the internet is going to change everything, which, to be fair, it did. But investors took that a little too literally. See, Wall Street loves a good story, and the story was that any company with a .com in its name was the future. Never mind that they weren't profitable or even functional. If it had a website and some buzzwords like synergy, e-commerce, or first mover advantage, money would rain down. And I mean actual millions. So why did this happen? It was a perfect storm of four things. First, hype. The media couldn't shut up about the internet. CNBC, Time Magazine, The Wall Street Journal, they were all running stories about the next Microsoft. Two, retail investors. Everyday people started trading stocks online for the first time ever. E-Trade and Ameritrade let anyone become a day trader from their couch. Three, venture capitalists. These guys were throwing money at internet startups like it was confetti at Coachella. If your pitch deck had the words web, scale, or network effect, congrats, you were funded. 4. Easy IPOs. Companies were going public in record time. No profits, no problem. Pets.com went public just 9 months after launching and raised $82 million with zero revenue. Valuations got unhinged. At its peak, the Nasdaq hit 5,048 in March 2000, more than double where it had been just 2 years prior. Companies with 20 employees were getting billion-dollar valuations, and Wall Street analysts were out here acting like PE ratios were optional. Let me paint you a picture of just how absurd things got. Pets.com literally spent more money on their Super Bowl commercial than they made in sales. eToys.com was valued higher than actual Toys R Us, which had real stores, real products, and profits. The entire economy started revolving around tech stocks. People were quitting their jobs to day trade. Taxi drivers were giving out stock tips. A 22-year-old with a PowerPoint could raise $10 million in venture funding. It was dumb money. Everywhere. Then, everything fell apart. It started in March 2000. The Nasdaq, which was full of these inflated tech stocks, peaked at 5,048. Then, people blinked and the sell-off began. Hard. Here's what went wrong. Burn rate. Most .com companies were burning cash like there was no tomorrow. And for them, there wasn't. Profitless growth. Investors finally realized, hey, maybe these companies should make money at some point. And interest rate hikes. The Federal Reserve started raising rates to cool the economy, which made speculative investing way less attractive. The result, a full-blown crash. From March 2000 to October 2002, the Nasdaq fell nearly 80%. That's not a misspeaking or a typo. Trillions of dollars in market value vanished. .com darlings like Pets.com, Cosmo.com, and eToys evaporated. Others like Amazon and eBay tanked, but they did survive. If you're a retail investor who bought the hype, you probably got wiped out. Same for employees whose stock options became worthless. But not everyone lost. VCs who exited early cashed out big. Bankers who took these companies public pocketed millions in fees. And of course, the founders who sold their companies before the crash, they walked away with generational wealth. The .com crash didn't just nuke investors. It hit the whole economy hard. Unemployment rose as tech firms laid off tens of thousands. Consumer confidence tanked, especially in tech-heavy cities like San Francisco and Seattle. Recession hit in early 2001, which was made worse by the 9/11 attacks later that year. Even venture capital dried up. Funding for startups basically froze for several years. What's wild is that the damage was mostly psychological. The internet wasn't fake, it was real, but people had bet on the future way too early and way too aggressively. Here's the kicker. Everything the .com companies promised online shopping, streaming, social networking. It all came true, just not in 1999. If you look at Amazon, Google, or Facebook, they delivered on the dream, but they did it with real business models, profitability, and execution. The dot-com crash wasn't about the internet being a bad idea. It was about people mistaking a good idea for instant riches. But we didn't learn. Crypto, NFTs, SPACs, meme stocks, we've run this playbook 100 times. But here's the silver lining. Some of the biggest companies today were born during or even after the crash. Amazon nearly died in the crash, but it came back stronger than ever. Google IPO'd in 2004 once the dust settled. Salesforce and LinkedIn launched in the early 2000s, and the whole venture capital scene matured. VCs became more skeptical, focused on revenue and unit economics instead of just the vibes. It also led to reforms, like stricter IPO standards, Sarbanes-Oxley for financial disclosures, and way more scrutiny from the SEC. So what can we take away from the dot-com bubble? First, hype is dangerous. 2, timing matters more than ideas. And 3, if your business plan is grow fast and profit later, just remember, later might never actually come. The dot-com bubble was a $5 trillion lesson in patience and reality checks. It wrecked a lot of people, but it also cleared a way for real innovation. So the next time you see a company promising to change the world, ask one simple question. How exactly are you making money? Now I want to hear from you. Would you have invested in pets.com? Do you think today's tech boom is just another bubble in disguise? Drop a comment below and let's talk. If you like this breakdown, make sure to like and subscribe. We're diving into the world of corporate raiders, the guys who get rich by gutting companies, firing thousands, and calling it strategy. See you in the next one.